What's going on, everybody, and welcome to the video. In this one, we're going to be talking about a dividend stock that I'm very likely going to be adding into my portfolio. It's something that it's a little bit different than most of my other slices in my pie on M1 Finance. We see I've got tech, banking, restaurants, consumer and stores, real estate. But this is going to be a little bit different of one. Maybe you've heard of the stock. It is Caterpillar, ticker CAT. We're going to be taking a deep analysis into this stock and why I'm liking it right now. So if you do enjoy this type of content, I'll ask you to subscribe to the channel and you turn on post notifications so you don't miss out on any of my future content. But let's go ahead and get straight into it. So first up, kind of like we usually do, we'll go ahead and look at how my portfolio is doing over the past week. With it being Thursday, the portfolio so far is up 1.7% this past week in tech and cloud computing, up 0.5% in banking and fintech, up 0.43% in the income fund, up 3% with restaurants and food, which is just Starbucks. Starbucks doing very well right now. Up 0.56% with consumer and stores, and down 1.2% with real estate. And then if we go back to the smaller part of my portfolio, the passive investing is up about 0.82% total, which is just SPY and VIEW, kind of like that safety leverage, just in case things go south with the regular dividend portfolio. Let's go ahead and kind of look at what I'm talking about. So we're going to be taking a dive into pretty much Caterpillar, okay? Looking at this, I'm going to go ahead and zoom out a little bit so we can see the full screen. Caterpillar, here's its 1 year performance. If you do want to get access to all the spreadsheets that I've been creating and using that I'll show you guys later in the videos and stuff, check out the link in the description down below, the Patreon. You can get these and start finding incredible stuff. So let's go ahead and just talk about it. So it's going to be an industrial stock, something that I don't actually have in my portfolio at all. And then farm and heavy construction machinery. And they do have a really nice forward PE of 14.63. Just kind of looking at everything. This is kind of the Finvis stock screen right here that we're seeing. We've got some pretty good numbers. Earnings per share next year, 7%, sort of slow, but the next 5 years, the annual growth rate is 13.22%. Looking very solid. Right now they have a dividend yield of 1.93%, and they pay about $4.80 per share. And this isn't anything to be worried about, safety-wise. It has a 35% payout ratio. And then also they do have a 29-year dividend growth streak, which is very, very good and stuff we like to see. Sitting about $127 billion market cap. Let's go ahead and kind of get a little bit deeper into this stock analysis and why I like the company. So first up, we're going with the DCF analysis. This one is negative, actually, just typing after getting in all the free cash flows and getting the terminal value and kind of getting these different discount rates, perpetual growth rates on this company. We do have a DCF price per share of $229.62 with the current price of $248, giving us a little bit of downside of about 7.67% downside. So this is something that I am keeping in mind before I just like to put money into this stock regardless. But if we go ahead and look at the dividend discount model, what we're seeing is, here's kind of the formulas. If you do, like I said, if you want access to this, check out the link in the description down below. It's very easy to use and gets you a nice value and a nice little intrinsic value of each company within like 5-10 minutes. So what we're seeing is it's got a dividend discount model price of about $299 per share. Remember, that's about $30 more than it currently sits. It's about upside of 11.26%. Pretty good dividend growth rate, over the past 5 years, about 11.47%. That's definitely very good stuff that we'd like to see. Next up, we're going to be calculating the actual perso intrinsic value of this company. And we'll see, just type in the ticker. Most of the stuff will pull up except for these two. You have to type in yourself and however large you want your margin of safety to be. But what we got right here is intrinsic value on this company is calculated to be $358.90. Currently trades for $248. That's a very big difference. It's a 44% difference. And with even a margin of safety of 10%, still saying this is a very good buy price. I could even change this real quick, and we're still getting a very good buy price. $40 ahead of its current price is still rated as a buy. So looking very solid based off of this valuation. And then the last model we'll look at is the multiples valuation, just kind of taking some competition, seeing what their PE is, their earnings per share, and what we expect out of Caterpillar. And seeing this, it's very, very flat. The combined valuation when it comes to this gives Caterpillar a $248.37 kind of valuation, with its current price being just like 33 cents above that. Okay, that gives you downside of about 0.13%. And then we go ahead and we just look at the final overall analysis of where this stock is headed based on these valuations. Remember, DCF price was $229 a share. Dividend discount price was $299 a share. Grams price was $287 because after we did all this stuff, it says a good buy price, 287. But if we wanted to kind of increase this a little bit, I think 20% is a little bit high of a margin of safety, just to be completely honest. I'm going to go with 15. Don't want it to be too low, don't want it to be too high, so it's about $305 is kind of the final intrinsic value that we're working with. And then the multiples model is about $248. This gives Caterpillar a final stock value of about $270.68, up about 8.84% of its current price. So saying a good buy price is around this current stock, where it sits right now, about $251.73. So based on these valuations, this is saying the stock is a buy. And if you do want to access this, check out the Patreon and the link in the description down below. Another thing I wanted to look at was the magic formula. If you haven't heard of it, it's from Joel Greenblatt. He takes a ton of companies, kind of just enters in these formulas to get the return on capital and the earnings yield, the EBIT divided by enterprise value. And pretty much you just type in these numbers, and it's very, very easy to get this information. So what I did is I created, you just have to type in the numbers manually. It's very simple to do. You can find all this data on Yahoo Finance. I'll show you how to do it in another video. But you got the earnings yield right here, and then you get the return on capital to the right. And then you rank these companies kind of in the highest earnings yield and the highest return on capital. And it's said that if you look at through a ton of companies, you're supposed to get 20 to 30 a year. And his returns have been absurd, 30% per year since 1994, 20%. Incredible returns, almost always outperforming the S&P. So definitely something to keep in mind is the magic formula. Definitely seems like it's got huge upside potential. But that is going to wrap it up for this video. So I do believe I will be adding ticker CAT into my portfolio in the next day or two. So if you did enjoy this video, make sure to subscribe to the channel and turn on post notifications so you don't miss out on any of my future content. Thank you again for making it to the end. Check the links in the description down below. Like I said, you can use M1 Finance to get some free stocks and free money. And if you want to get these access to these spreadsheets, check out my Patreon in the description down below. And I will see you at the next video.